In this video, I will share the 5 biggest mistakes I see investors make time and time again. And more importantly, avoiding these sometimes simple mistakes could lead to significantly better returns over the years, especially when you take number 3 into account, what can cost you a lot of money. So let's dive right into number 1, having a wrong asset allocation, and let me explain what I mean by this. Because it's no secret that many investors make the critical mistake of focusing too much on the wrong asset allocation. What do I mean by this? And this is very important, yet so much people struggle with this. When you start investing, we often hear the question, how much risk are you able to handle? And unfortunately, many respond with, I don't want to lose any more money, Maurice. And while this is a very logical response, this can lead to an important misstep. Let me explain. Because, of course, nobody wants to lose money, right? Especially when investing. Take this simple example where you have $1 million to invest in your 40s and don't want to lose your money. And I will show you that a lot of people are choosing the wrong asset allocation. So take this image for example, and let me explain this in simple words. On the left side, you see 100% a bond portfolio, right? Has an average return of 5.3% with returns ranging from minus 8.1% to plus 32.6%. When you move over to the right, you see a 100% stock portfolio. It has a higher average return of 10.3% with a much wider range from minus 43% to 54%, right? Everything in between is a mix of bonds and stocks. You can also see that the left side looks like the safest option, while the right side has more risk involved. Now, back to the example of investing $1 million, because people often come to me and say, Maurice, I don't want to lose my investment, but if I had to accept a loss, I wouldn't want it to exceed 25%. So what happens? Many investors choose a 50-50% asset allocation based on this image, aiming to limit their risk to 25%. But here lies the problem. Most people focus too much on short-term volatility without fully understanding the long-term impact. So let's change your perspective about risk with this new graph, because a lot of people keep on saying, I'd rather keep my savings because investing is really risky. But honestly, they don't know what they are talking about. And this costs you literally millions over the years if you don't start today. So let me explain, because now let's look at the same data from a different angle. In the next graph, we highlight short-term risk versus long-term risk. Here you see stocks show a downside risk of minus 43% with an upside potential of plus 61%, while bonds have a downside of 23% and an upside of plus 48%. But this is really important, and here's the critical insight what can save you a lot of money. In this graph, you can almost say that stocks are safer than bonds if you compare the long-term results, right? Do you see how this brings a whole new perspective? The longer you invest and the more time you give your money to grow, the less impact your short-term risks have on your overall returns. And the best part is, when investors realize this, they often shift perspective and also their asset allocation, as it highlights that long-term stock investments tend to yield positive returns despite short-term volatility. But you might think, but Maurice, there's only a 2% difference in returns per year between a 50-50% portfolio and a 100% asset allocation in stocks. And yes, that's true, but here's why this matters to your portfolio. Because over 30 years, even a 2% difference can lead to a significant difference in your portfolio. For example, if you invest $1 million at an 8.3% return, after 30 years, you would have approximately $11 million. But in contrast, a 10.3% return would grow that same $1 million to almost $19 million. Yes, that's a difference of over $8 million. And of course, we must recognize that risk is not something that can be measured. and each investor has a unique risk tolerance and comfort level. While you theoretically could better choose a 100% stock portfolio as the optimal strategy, if it causes your anxiety and prevents you from sleeping at night, then practically speaking, it's not the right choice for you, right? But when investors understand this difference, they often choose a different asset allocation, what delivers better returns. So here you see that a 2% difference can make a huge impact. But what about cost? Now let's dive into number 2, keeping costs low. But I have seen that many people paying an asset manager simply 2 to 3% per year easily, and a lot of times they are not aware of the cost. They pay a management fee but often overlook that there are other costs involved, such as fund expenses that are not included in the total costs. So these fees can add up quickly and eat into your returns. One of the most compelling reasons to keep investment costs low is the power of compound interest. Compound interest allows the money you earn on your investment to generate additional earnings over time. Essentially, it's interest on interest, and it can add up significantly. And that's why Jack Bogle's first rule from this 26 investment lessons is to keep costs low. You can find the video with all the 26 lessons here above. Then we dive into number 3, and that is chasing past performance. Chasing high performance means that investors look for the best funds, the best ETFs, or the best stocks that have done really well recently. They believe that just because something has done well in the past, it will keep doing well in the future. However, this way of thinking can cause problems for a few reasons. A study by Morningstar highlights this issue as well. They found that funds that ranked in the top quartile for performance over 1 year often fell to the bottom quartile in subsequent years. And Jack Bogle emphasizes on this problem of chasing past performance in the next video as well.
Don't buy funds on the basis of past performance because it's not going to continue, or it's only the extraordinary case when it's going to continue. So people tend to, as I mentioned earlier, put their money into these big winners, and then down it goes. They pick the high because that's when the fund looks the best. So in that part of my recommendations, recommendation 1, I've taken 8 of the best known and most successful mutual funds of the modern era, and I've charted their return year after year cumulatively against the S&P, the Standard & Poor's 500 index. And every fund looks the same, although all the time periods are different. The fund goes like this, and then it goes like this. This, over and over and over again. And you see this in the big winners of the age.
So that brings us to mistake number 4, trying to time the market. Because many investors attempt to avoid risk by stepping out when they believe the market is at an all-time high. However, this approach is incredibly challenging because it requires being right twice in a row. First, to know when to exit, and secondly, to determine the right moment to re-enter the market. As we discussed in this video, getting it wrong can be really costly. Unfortunately, trying to time the market often results in buying high and selling low, especially when emotions come into play. Just as chasing past performance can lead to poor decisions, attempting to time the market can trap investors in a cycle of reacting to short-term fluctuations rather than sticking to a well thought out investment strategy. So remember, time in the market is much more important than timing the market. So how can you effectively invest for the long term? By employing strategies like dollar cost averaging, you can make consistent contributions over time. Now let's move into mistake number 5, allowing emotions to drive your investment decisions. Like we all know, emotions can lead us to stumble into traps we have discussed before, like poor asset allocation, chasing past performers, attempting to time the market, and ending up with high fees. When markets get volatile, fear and greed can take control, especially when you turn on the news where they excel at triggering your fear with negative headlines. And you might panic and sell during a downturn because of the latest all-time highs, right? These emotional reactions can result in costly mistakes that can significantly impact your financial future the most. And let's be honest, we often think this won't happen to me, right? But here's the thing. Just like we all understand that big market drops will happen at some point in our investment journey, we also know that we all have days filled with strong emotions, right? We may not know exactly when it will hit, but we all know that someday these emotions will come rushing in. And by recognizing this and having a solid plan in place, we can better prepare ourselves for those challenging days. And I know this from working with clients for over 15 years in the investment industry. I have seen many investors who understand everything in detail, but when things go wrong, they let their emotions take over. So that's why I recommend considering the best 3 ETF portfolio we will discuss in this video. Having a well-diversified ETF portfolio is essential because it spreads your investment across different sectors and different asset classes, which can help reduce risk and have great returns over time. So, see you in the next video.